Hey guys, welcome to Chapter 3, which is Life Insurance Policy, Riders, Provisions, Options, and Exclusions. So these are going to be all the different aspects on top of the life insurance policies that we're going to go ahead and dive into right now. Again, guys, Chapter 3, it's going to be Life Insurance Policy, Riders, Provisions, Options, and Exclusions. We're going to go ahead and skip right down the chapter recap. Hopefully you guys are doing your reading and developing that foundation for your knowledge. Policy provisions, the standard provisions in all the life insurance policies is consideration. We talked about it in chapter 1, really developing the idea of parties having an equal kind of exchange or something of value inside of this contract. So consideration, we're giving the life insurance company premiums, they're giving us, the life insurance coverage or death benefit. Entire contract. So understand that entire policy also has riders and amendments along with the copy of the application. Grace period. This is where the insurance company is showing us some grace. Life happens. Sometimes, we miss a premium payment or whatever it may be. But the grace period is the time period after the premium is due during which the policy will not lapse. Typically, it's 30 days. Let's say that we miss a premium payment on the 15th. We'll typically have 30 days, next month on the 15th to pay that premium and make sure that policy does not lapse and that we stay in good standing in consideration with that life insurance company. Incontestability. The insurer cannot contest misstatements on the application after a time period, which is going to be 2 years. You have a 2-year incontestability period. Anything, if you have a life insurance policy and you pass away during the first 2 years of having that life insurance policy, the insurance company can go back and say, hey, you had heart conditions when you said you didn't have heart conditions, or suicide's a big one. If you get a life insurance policy and you commit suicide within having 2 years of that life insurance policy, they're not going to pay the premiums. But once you get past that 2 years, they can't go back and say, hey, there was misstatements on the application. You're a smoker and you told us you were a non-smoker, whatever it may be. So understand that incontestability, the life insurance company cannot dispute anything that was on the application. And typically, as long as your premiums are paid, they have to pay that life insurance debt benefit. Insuring clause, this is the basic agreement between the insurer and the policy owner, saying, hey, we're insuring you based off your health, based off the premium amounts that you've agreed upon, and based off of the death benefit that we've agreed upon. That's the insurability clause. That's pretty much the idea of the life insurance protection clause in the contract. Misstatement of age or gender. The death benefit is going to be adjusted accordingly to the correct age and gender at policy issue. Mistakes happen, guys. Maybe you check the wrong box on gender. Maybe you type in the wrong number on the application because a lot of it's electronic now. Maybe you type or write the wrong number for somebody's date of birth. It's going to be based off of, whatever their real legal age and gender is at the time of policy issue for whatever that death benefit is. If you say somebody's a year younger, the life insurance company is going to come back and say, hey, based off of, being a little bit older than what we had on the application or whatever it may be, we're going to pay that death benefit accordingly. Payment of premiums. Premiums are paid in advance, right? So you're paying your premiums before you receive the benefit of the death benefit. So reinstatement, a policy that can be restored within a specific period of time with proof of insurability. So let's say that we have a life insurance policy, we miss a premium, we didn't pay that premium back within the grace period. We can reinstate a policy and it can be restored as long as it's not too far away, but you will have to have probably, maybe some proof of insurability. Depending on the insurance company, they might let you slide if you barely miss the grace period. Other provisions, assignment, which is either absolute or collateral. A lot of times you'll see a new assignment as far as, who's the owner of that life insurance policy. We can get into the weeds, and it's called a biatical life insurance policy, where somebody buys a life insurance policy. They're like, hey, you're near the end of your life, but you really need the cash now just to keep your house mortgage payment. You might have a third party come back and pay you some cash to become the owner of that life insurance policy. But what's more common is you'll change the assignment. Is maybe, a father or a mother get a life insurance policy on their kid, for their kid, and now that they're 18, they change the assignment so that the kid picks up the premiums, and it's based off them as the insured, and they become the owner of their own life insurance policy. Exclusions, aviations, hazardous occupation, war, military service, suicide within a specific period of time. Those are obviously risk and exclusions that the insurance company is not going to want to take. If you fly like airplanes a lot and you're a pilot, that obviously is increased risk for the life insurance aspect. Hazardous occupation, maybe it's oil field worker, whatever it may be. If it's too hazardous of an occupation, maybe they don't want to take that risk. War or military service, obviously, naturally, you're putting yourself on the line. Thank you to all of our veterans out there. But typically, the life insurance companies don't really like to make those kinds of risk if you're active military. Obviously, suicide. If you have suicide background or you have that suicide within the 2-year incontestability time period, typically that's going to be an exclusion for the life insurance to pay. Free look, the policy can be returned for a refund of premium within a specific period of time. Typically that free look period is going to be about 30 days. Say, hey, I have the application, I paid the premiums, I have this life insurance policy. They'll give you, a specific time period. Typically it's around the 30-day mark to say, okay, I'm glad I have this life insurance policy. I pretty much was given this service and I feel comfortable with it. Yes, I want to keep it. Or maybe, I just kind of reevaluate things. I don't really want anymore. They'll refund the premium as long as you get it within that specific time period. Ownership, the policy owner's rights. You can own a policy and don't have to be the insured. It could be your children. It could be, your spouse. It could be your business partner, but you can still own the policy. The beneficiary can be somebody else. So you have the ownership rights, which really means that you can change the beneficiary aspects. You can't change the insured because it's based off that person's life, but you can change who owns the policy and you can change the beneficiary. So beneficiary designations, including, which is your beneficiary designations is going to be individuals, which can include minors. You can leave it to your children. It can be classes and it can be estates. You can leave the money to a trust. A lot of people, if they have a trust and they want to do the waterfall method, which is kind of the Rockefeller method, and we'll have training concepts on that as well, where you pay back that trust, as far as the life insurance policy death benefit goes. But a lot of people are going to be leaving it to their spouse, their children, whoever it may be. Maybe it's a brother if you're not married yet, or maybe it's your parents if you're very young and have a life insurance policy. Succession. This is the levels of priority. Each level in succession is only eligible if the beneficiary in the level above has died. So what that means is whenever you have your beneficiary designations, you're going to have your primary, beneficiaries, which is, let's just say your primary is you have a spouse and you want to leave your primary, death benefit to your spouse. But for whatever reason, God forbid, both of you guys are in a car accident and you guys both die at the same time. Naturally, you can't leave that money to your primary beneficiary. It's going to be passed down to your contingent beneficiaries, which is going to be the secondary claim for that death benefit, which is after the primary. So a lot of times, like I said, the primary is going to be a spouse, and then the contingent is going to be maybe some parents, maybe it's your children, whatever it may be. So primary is first, contingent is next, which is secondary because it's contingent on that first person, that primary beneficiary still being alive at that time. Policy owner's right to change the beneficiary. It's revocable. It can be changed at any time. That is most life insurance policies. Irrevocable can only be changed with the beneficiary's consent. Typically, you're going to see that in kind of a trust situation. But more than anything, if you're the policy owner, 95% of the time, you're going to be able to change the beneficiary at any time. But again, if it's a trust situation where it's an irrevocable life insurance trust, then it's going to be, an irreversible decision. So think about revocable as in reversible, as in you can change at any time. Irrevocable is irreversible, and you can't change it once you've already made that decision without the beneficiary's consent. Common disaster clause. So this protects the right of contingent beneficiaries. If the insured and the primary beneficiary died at approximately the same time, it is assumed that the primary, beneficiary died first. So kind of the same exact example that I used earlier. Let's say that you guys, husband and a wife, or spouse and spouse, partner and partner, died in a car accident, and maybe one individual who owned the life insurance policy died first, but the other person was put in ICU, critical care, ended up dying later. This is the common disaster clause, where they're going to say that they pretty much died approximately at the same time, so that contingent beneficiary is going to receive the proceeds for the death benefit. Policy loans, withdrawals, and partial surrenders. I've mentioned this a few times, guys, regarding the cash value, and this is what it's talking about. The cash loans are available, so you build up that cash value. So the policy's cash value minus any unpaid loans and interest. Again, what that means is we build up this cash value of $100,000. Say we have a death benefit of $100,000, so our cash value is equal with the death benefit. Let's say we borrow $50,000 out of that cash value. We die, we don't pay back that loan. You're going to have $50,000 of that going, $50,000 of that $100,000 death benefit is going to pay off the loan, and the remaining amount, which is going to be an additional $50,000, is going to be passed on to your beneficiary. So again, $100,000 cash value, $100,000 death benefit. We borrow 50, we don't pay it back. That death benefit is going to pay that loan amount, and the remaining amount is going to go to the beneficiary. Riders. So think of your life insurance policy as a car, and the riders are all the extra bells and whistles. It's the spinners, it's the stripes, it's the the sunroof, or whatever it may be, right? So think of that as the additional accessories on your your life insurance policy. Disability. You can have a waiver of premium rider, which waives a premium if the insured is totally disabled. And typically you're going to have a 6-month waiting period before the benefits begin. So if you're totally disabled, you get a doctor's note saying, hey, this person's unable to work. They're typically going to have you wait 6 months before you can start receiving the waiver of premium benefit. Waiver of monthly deductions. This waives the cost of insurance in the event of the insured's disability. Kind of goes a little bit hand in hand with the waiver of premium. You're typically going to see waiver of premium compared to waiver of monthly deductions. But just know that waives the cost of insurance in the event of an insured's disability. Payer benefit functions like a waiver of premium rider, but it's used for juvenile policies. So it really helps kind of the minors, or child, whatever can't do, pay for that premium, whatever it may be. So that's the payer benefit. You might want to read up on that, because that gets a little bit particular based off the minors and the juvenile policy aspect. But more than anything, guys, you're going to see waiver of premium in a more real life applicable situation. Disability income is going to waive the premiums and pay monthly income. So you can have a disability income where they start paying you income if you do get disabled. It's going to waive the premium, just like the waiver of premium, but the disability income is also going to provide you some income if you do get disabled, with that rider attached to your life insurance policy. Accelerated death benefit. Accelerated benefit. Early payment if the insured is diagnosed with a specific catastrophic illness. I kind of touched on it earlier. They're going to say, hey, you have this catastrophic illness. We have to pay this death benefit out anyways. And if it checks our box for, that type of illness, we're going to go ahead and front you a portion of that death benefit. Sometimes it's 25%, sometimes it's 50% of that death benefit, sometimes it's 75% of that death benefit. So the death benefit is going to be reduced by the amount plus any earnings lost by the insurer. So what that means is, if you have a $100,000 death benefit, you get one of the catastrophic illnesses, and they're going to front you 50%. They're going to give you $50,000, up front, and obviously that's going to be type of a loan, so they might take some interest off that. But typically, they're just going to front that $50,000. The rest of your death benefit, the additional $50,000, will be then left to your beneficiaries. Additional insured. This is a spouse or other insured type of term rider. It's going to be a limited time. Limited coverage, again, term, temporary limitations there. Usually expires when the spouse turns age 65 because naturally that's when term life insurance and life insurance as a whole gets really expensive. Child's term. That covers all children of the insured. Again, a term aspect, limited time, limited coverage, and it can be converted to a permanent policy. So that really benefits, the children whenever you get that kind of rider attached for additional insured. Because they're younger, they can get approved at a much more efficient life insurance rate for permanent life insurance. So very important to understand that aspect for the children if they want to convert to a permanent policy. Non-family insured. Again, guys, it's used by businesses all the time. The key person insurance aspect. So you can have the additional insured on your life insurance policy if it's your business partner, whatever it may be. You see that a lot of times when, two people go into business together and maybe the other spouse or the other family doesn't know how to run the business. So you kind of take out life insurance on each other as far as the business owners so that they can buy out the remaining equity or the other half of the business to the family and give them tax-free money and use that tax-free money to buy them out so that they don't have to, the other family, the surviving family doesn't have to worry about running the business or anything like that. So it really helps the business owners make sure that the business stays with the business owners and they don't have to worry about bringing on other investors or the surviving family coming and taking over that role of running the business. Maybe they do or don't know how to run it. So it really protects the business and the business owners in that aspect for key person insurance policies. Accidental death. If you have an accidental death rider attached to your life insurance policy, that's going to pay double or triple indemnity if an accidental death occurs as defined in the policy. The death must occur within 90 days of the accident. A lot of times, guys, it's going to be like car accidents or something like that, where if it's an accident and it's not that person's fault or whatever it may be, and they die within the 90 days of that accident, you're typically going to pay, double or triple, whatever cash death benefit amount that they have. So that's a very important one to think about, guys. For the accidental death, things happen, early deaths happen, accidents happen, and that's a way that you can provide, double or triple death benefit and indemnity to your clients. Guaranteed insurability. This allows for purchase of additional insurance at specified times without evidence of insurability at the insured's attained age. Again, that's kind of the convertibility aspect. So if you have a term for 20 years, they're going to guarantee insurability if you want to convert that to a permanent policy or whatever the situation may be. Guaranteed insurability is a really big aspect and something that you really want to look for. Return of premium. Increasing term is added to a whole life policy that provides that if the death occurs prior to a given age, not only is the death benefit payable to the beneficiary, but all the premiums as well. So that's a really good one. Maybe it's maybe you paid into it for quite a while, you have the death benefit, but if you have the return of premium, they're going to give you all the premiums that you paid back, so you get even a little bit more than just the death benefit as well. So look at that kind of situation. You'll see that in some kind of term policies, but also you can have that increasing term added to that whole life policy because that's typically going to be associated with the term. If you have like a whole life policy along with the additional attached term, that can have a return of premium rider as well. Cost of living. Similar to cost of living, inflation, everything, that's going to automatically increase the amount of insurance without, evidence of insurability. As cost of living goes up, inflation goes up, they're basically going to say that, hey, we're going to increase the amounts of insurance that you have without providing any different kinds of insurability aspects, because we're just going to kind of keep up with inflation and the cost of living aspect. That's another really good rider to think about. Options. This is really the different options when it comes to settlements or non-forfeiture or dividend aspects of how you really want that to affect your life insurance policy. So non-forfeiture, which is reduced paid up insurance, that uses the cash value as a single premium to purchase a permanent policy with a reduced face amount. Let's say we've been using this example a few times. Let's say that we have a $100,000 death benefit. We have a $100,000, or let's just say $50,000 cash value. We haven't paid as much into it, so we have a $100,000 death benefit, $50,000 cash value. If you don't end up, making any more premium payments or you let it lapse, automatically they're going to take that $50,000 and go ahead and buy you a permanent life insurance policy. That's probably going to be, $50,000 to $75,000 death benefit. So that's the reduced paid up insurance aspect. They're going to take whatever cash value that you have if you let that policy lapse, and they're just going to go ahead and purchase a single premium life insurance policy for you. That's an example, a really good example of when you'll see the single premium whole life aspect or whatever it may be. Extended term, an automatic option. So it uses the cash value to convert to term insurance. It's the same aspect. They're going to take, that cash value, and they're going to typically keep that death benefit the same. Again, same example. Let's say we have a $100,000 death benefit. We have $50,000, cash value. They're going to give you a term that's equivalent to a $100,000 death benefit by utilizing that cash value to fund that term life insurance policy. Depending on your age, the term will, differ. So understand that. And then the cash surrender value, after that, no more insurance. So what they'll do is they'll just send you that cash, whatever cash you have built up. Again, we're not making any more payments on it. It lapsed. They don't want it anymore. They have a $100,000 death benefit, $50,000 cash value. Whatever that cash value surrender is, they're just going to send you a check directly to the person. So those are the three different ways for, if non-forfeiture, where, the insurance company, I hate to say it, but they want your business. So typically, you're automatically going to have a reduced paid up insurance, or you're going to have an extended term, which I really recommend if somebody's going to forfeit that money, go ahead and get them that permanent life insurance. Even though it's, a reduced death benefit, they're still going to have permanent life insurance. They're not going to have to worry about making any more premiums. And just in case they do kind of live out that extended term aspect, they still have that, permanent life insurance policy. The cash surrender value might be a decent idea if they need some tax-free income, or maybe they want to go buy, a property and invest their money differently than outside of kind of a life insurance policy cash value type situation. Dividend. You can receive, as you build that cash value, you're going to receive dividends, you're going to receive interest in that cash value. So you can either have, the insurer pay you a direct check to the insured. You can take that, dividends or whatever cash that you have, or interest that you're earning on the account, and pay directly to the insured. Or you can do a reduction of premium, which again, I kind of mentioned in the 10 pay or the limited pay whole life insurance. You can use those dividends and the interest that you earn to pay down that premium, even if it's a portion or if it's the whole amount. That dividend can be applied to next year's premium. Or you can just accumulate interest. Accumulation of interest, the insured pays a dividend in an account where it accumulates interest. This is the whole idea of the cash value. You're going to gain interest, and you're going to gain so much interest that it's going to grow. But essentially, we would eventually like for it to start to reduce premium, save a little bit of money for the insured, especially as they get older in age or whatever it may be. Or you can really build that cash value that they want to borrow from later. Whatever their goals are, whatever they want to achieve, that's very important. Again, similar to the idea of the reduced paid up insurance, you can do a paid up addition where the dividend is used to increase the face amount. So if you want to use that dividend to essentially pay for more insurance, use that cash value to pay for more of the insurance side, it's going to raise that face amount. Paid up insurance is a dividend that's going to use to pay up that policy early, kind of like the limited pay aspect. You're going to use all the dividends, all the interest from that cash value and the dividends that you receive to pay that policy up a little bit earlier. 1 year term, you can use the dividends again to buy additional life insurance through the term aspect. So the dividend is used to buy additional insurance, and that's going to be, the 1 year term aspect. They'll take the dividend from the cash value and buy you another kind of term just for a little bit more pure protection of life insurance. Settlement. However we settle, whether this is paid out to a beneficiary or, you want to start to take payments from it, whatever it is, you can get cash, which is a lump sum payment, which is typically not taxable. 99% of the time, it's going to be tax-free income. The only time it's not is if you MEC it or there's some other kind of issues with the creation of that policy. but 99% of the time, it's usually not taxable. You can get life income. This provides an income for the beneficiary that they cannot outlive. No guarantee that the entire principal will be paid out if the beneficiary dies too soon. Again, life insurance is all about making bets on when that individual is going to pass. So, there's no guarantees that the entire principal will be paid out if that beneficiary dies early, but it will be paid out for their lifetime. And it's available as either single life or joint life. If it's left to maybe it's left to one beneficiary, or maybe it's left to a joint type situation where it's going to be paid out on that survivor. Interest only, the insurer retains the principal and just pays out the interest. So pretty simple there. Interest only, they're just paying out the interest that is gained on that cash value or that life insurance policy. Kind of similar to the annuity aspect, guys. You can do fixed period. The annuity is a certain period. So the payments are going to be paid out for a specific period until all the proceeds are paid out. So, hey, we want, a fixed period of time that we're going to pay out all these proceeds. Again, like the annuity, certain amount or fixed amount in this situation for the life insurance policies, the payments are made in specified amounts until all the proceeds are paid out. So these are different type of settlement options, not only for a beneficiary, but some of this also applies to how you can draw the life insurance or draw the cash value, and also different aspects in that as well as far as just overall settlement options. Maybe it lapsed, or maybe you guys don't want to pay for it anymore, or the beneficiary receives it, or you're taking some retirement income from it, whatever it may be. Understand all the settlement options. That's really going to overlap with a lot of the annuity aspect, but make sure that you know the different options as far as the non-forfeiture, how the dividends are going to accrue, because that can either really grow that cash value, that can buy more insurance, or that can lower your premiums. So the dividend aspect is going to be really important whenever you do create a life insurance policy for a client. And then the settlement aspects, more than often, that's going to be talking about the beneficiary aspects, but also can be talking about how you draw retirement income if you have a specified rider on that account, or that policy. Guys, know the riders. They're really, really important. The disability aspect, the accelerated benefit, additional insured, and riders that affect the death benefit. Those are all very important. Disability is really important, especially for, the juveniles. You want to look at the juvenile situation. Accelerated benefit, that's typically going to be like the long-term care features. So you really want to understand that that's associated with illnesses, long-term care. Somebody can't do, two of the daily living activities. And the additional insured, it's typically going to be talking about maybe businesses or spouses, also children, and the convertibility aspect there. And just last touch, guys, understand the policy provisions. That's really going to go into depth on how that policy is going to be regulated as far as the grace periods, incontestability, misstatements, whether it's age or gender, how the premiums are going to be paid in accordance to the death benefit, and the different policy provisions as far as assignment, free look, ownership, and all the different beneficiary designations. That's going to be really important for you guys to understand in the real world whenever you're writing policies, knowing primaries, knowing the contingent beneficiaries, and everything that goes into that. So that wraps up our Chapter 3 recap. Hopefully this helped bring some stuff together and really kind of create this foundation for your line of thinking when it comes to the life insurance policy riders, provisions, options, and exclusions. Thanks, guys, for listening.